Lower mortgage rates brought both buyers and sellers back to the market. That's what Zillow is saying, but is it the full story? I've dug deeper into the data, and there's more to this than meets the eye. In this video, I'm going to go beyond the headlines to show you what's really happening in different regions and price points. You'll see why some areas are heating up while others are cooling down, and how to use this information to your advantage. Mortgage rates have been highly volatile lately, creating uncertainty for buyers and sellers in the housing market. Let's look at the recent trends. In September, mortgage rates dropped to a two-year low of 6.08%, significantly impacting home affordability. For a typical buyer who could afford the mortgage payment on an average home in May, this rate drop increased their buying power by $40,000. However, the market quickly shifted. After a strong jobs report in early October, mortgage rates spiked again. For buyers who hesitated, their monthly mortgage payment for a typical home with a 20% down payment increased by $175. These rapid changes have made it challenging for buyers to plan their budgets and for sellers to gauge the pool of potential home buyers. The impact on buyers is substantial. One month they might stretch to afford their dream home, the next they could find themselves priced out of the market entirely. Sellers are also affected as the number of potential buyers fluctuates with each rate change. More buyers enter the market when rates drop, potentially driving up competition and prices. But when rates spike, some buyers may back out, leading to fewer offers or longer time on the market. Despite the October spike, buyers who could afford the mortgage payment on a typical home in May have seen a significant increase in their buying power over just 4 months. However, it's crucial to remember that this assumes home prices remain constant, which isn't always the case in real estate market conditions. The volatility in mortgage rates is primarily due to stronger than expected economic data and anticipation of potential economic policies. The Federal Reserve's ongoing adjustments based on incoming economic information suggest we might continue to see fluctuations in the coming months. Interestingly, not all markets react similarly to the mortgage rate changes. Some areas are experiencing increased activity while others are seeing a slowdown, adding another layer of complexity to the current real estate landscape. If you've been following me for a while, you know my experience has taught me that informed consumers save money and are happier during their move. That's why I often use Zillow data to assess U.S. housing market conditions. If you're not a subscriber, please click the thumbs up like button and subscribe now so that you get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to learn the tips and tricks that put extra money in your pocket, then subscribe now and I'll keep you in the know. $360,999. That's the typical U.S. home value according to Zillow's latest data. But this number can be wildly different depending upon where you live. Let's look at what's going on across the country. If you're considering buying a home with a 20% down payment, you're looking at a typical monthly mortgage payment of $1,760. This payment is down 7.5% from last year, but still up 97.3% since before the pandemic. That's a huge jump in just a few years. Things get interesting when we zoom in on different parts of the country. Of the 50 largest metro areas in the U.S., 43 have seen home values increase compared to last year. San Jose leads the pack with 7.8% increase, followed by Hartford at 7.6%, New York at 7.1%, Providence at 7%, and Buffalo at 5.9%. But it's not all growth everywhere. 7 major metro areas have seen home values drop. New Orleans and Austin are down 4%, San Antonio is down 2.7%, and Birmingham and Tampa show slight decreases of 0.7% and 0.5% respectively. This data shows us that the housing market varies significantly from one area to another. Some markets are hot while others are cooling off. If you're thinking about buying or selling, you must pay close attention to what's happening in your area. That national average of $361,000 might not mean much if you're in a city where prices are skyrocketing or falling. The fact that mortgage payments are down from last year but still way up from pre-pandemic levels tells us something important. While things might be easing up in the short term, we're still in a much more expensive housing market than we were just a few years ago. So whether you're a buyer, seller, or just keeping an eye on the market, remember, your local trends matter. The national numbers are good to know, but they're just the starting point. What is your next step? Dig into the data for your specific area. That's where you'll find the information that matters for your real estate decisions. Let's examine some key market trends that might change how you view the current real estate landscape. Inventory levels tell an intriguing story. While new listings are down compared to last year and significantly lower than pre-pandemic levels, active listings have increased. This suggests homes stay on the market longer, leading to inventory buildup. However, we're still not back to pre-pandemic norms. Price cuts are another factor to consider. In September, about a quarter of listings had a price reduction. This is slightly down from last year, but it's important to note that MLS systems can sometimes mishandle this data. As for homes selling above the list price, we're seeing a decrease compared to last year. This indicates buyers are gaining some negotiating power, but sellers still have a good chance of getting their asking price or more. Newly pending sales have increased slightly since last year, suggesting buyer demand is rising. However, the median time for a listed home to go under contract has also risen, implying buyers are taking more time to make decisions. What does this mean for you? If you're buying, you might have more options than last year, but still fewer than before the pandemic. You're also less likely to face bidding wars. For sellers, while the market isn't as frenzied as in recent years, there's still strong demand. Just be prepared to price your home more aggressively. Remember, these are national trends. Your local market might tell a different story. It's always best to consult with a local real estate professional for the most accurate picture of what's happening in your area. Zillow's Market Heat Index reveals some surprising trends in real estate markets nationwide. While the market is in a neutral market, balancing buyer and seller advantages, individual cities tell a different story. San Jose, Buffalo, Hartford, Boston, and New York are currently the strongest sellers markets, giving homeowners the upper hand. In contrast, New Orleans, Miami, Jacksonville, Austin, and Tampa favor buyers, potentially offering more room for negotiation. Rental markets are seeing significant changes too. The typical U.S. asking rent has risen to $2,009, up 3.3% from last year. Since the pandemic began, rents have increased by a staggering 33.5%. Single-family homes have seen the most dramatic rise, with typical asking rents now at $2,215, a 40.5% increase since the start of the pandemic. Multifamily homes haven't been spared either, with typical asking rents at $1,855, up 26.9% since the pandemic began. These increases are putting pressure on renters, with the income needed to afford the typical U.S. rent now at $80,362. However, there are signs of a potential cool down in the rental market. The rental vacancy rate climbed to 6.9% in the third quarter of this year, 0.3 percentage points higher than last quarter and last year. This increase in vacant units could lead to more options for renters and possibly slower rent growth in the future. Understanding these market dynamics is crucial. Whether you're looking to buy, sell, or rent, the real estate landscape varies greatly from city to city, and these trends can significantly impact your decisions. In our final segment, I provide actionable advice based on these trends to help you make smarter real estate choices. Mortgage rates have been volatile, impacting buyer power and causing uncertainty. Regional differences are significant, with some areas heating up while others cool down. Inventory remains tight overall, but is slowly improving in specific markets. Buyers should watch mortgage rates closely and be ready to lock their rates when they dip. Consider looking in areas with more inventory, especially in the Southeast, where conditions are becoming more buyer-friendly. The rental market also offers opportunities, with 37.7% of listings now including concessions. Sellers are still in a good position in many markets, but must be realistic. Price your home competitively from the start and be prepared for negotiation. The days of multiple offers over the asking price are fading in many areas. Renters can take advantage of current market conditions by negotiating better lease terms. However, rents are still significantly higher than pre-pandemic levels, so careful budgeting is essential. Working with an experienced, active agent in your local market is crucial for navigating these complex conditions and making informed decisions. As we look ahead, the big question is whether we'll see a return to normal market conditions or if this volatility is here to stay. Staying informed will help you make the best of whatever the market brings. Selling a home has changed dramatically due to the immediacy of digital marketing and social media. Even amid my career's strongest sellers market, I continue to see sellers leaving money on the table. Don't let this happen to you. Check out this popular video featuring my top 6 home selling tips for 2024 and beyond.